gave up managing billions to become a better investor. Episode 23, earnings season, week 2, part 2. Hello. Yes, the corporate earnings season continues, which is tremendously exciting. But if I look at just Thursday and Friday of the week just finishing, there were loads of interesting numbers and thoughts out in the commodity, pharmaceutical, consumer and technology sectors and many others beside that. I was actually going to start, though, with a couple of names in the retail/travel area. And it's kind of interesting. I know what you're thinking. What on earth is retail/travel? Why is that a top 10 sector? If I look at the stock 600 or S&P 500 split, I don't see something like that. Reality is, of course, and go back to podcast 19 for more chat about this. I think you've got to change the way you think about markets, the sort of the sector split that you utilize. The world is changing and evolving. It's not just that consumer is becoming a bigger part of the economy, but just that you've got that sort of definition of companies just changing and evolving. Anyway, go back to podcast 19 for more chat about that. And the reason why I've got this retail/travel sector, as well as more generalist consumer ones and other sort of interesting areas on top of that. Anyway, back to retail/travel. Two names of interest to me over the last couple of business days. One was easyJet, listed in the UK, but obviously pan-European, centered in terms of their day-to-day operations. And American Express, US listed, but, a global operator, although the US is still their most important market. Kind of fascinating. I mean, it is interesting how their comments about what consumers are thinking and, more importantly, looking to do over the next year or two is, as always, a great insight into whether a company is cheap or expensive. It's not just, as I've talked about many times before, go beyond that notion of are they beating or missing short-term numbers. Start thinking more about, well, where is the future going? Not only what is the company doing, but where are they going to likely to go over the next 2 or 3 years? And naturally, as we talked about before, that's a chunk of macro and a lot of sector and individual stock qualitative analysis. It's not, you can of course run it all through a computer, but believe me, you get a lot smarter, much more likely to be a good, attractive investor if you actually kind of think it through yourself, such is the nature and the excitement of the investment world after all. Anyway, back to easyJet. I do think the share is still cheap. It's interesting. The numbers they released on Thursday, it wasn't a full set of numbers. They will come out later in the year. Nevertheless, their progress is good from a revenue, from an indicative kind of profit perspective, which, are good ways to sort of start with. Naturally, the sector itself, airline and related and associated holiday and travel perspectives, you can find reasons to be cautious. Cost of living crisis and related over the next year or two. But I kind of feel that the sort of the impression, the perspective that the average investor still has about easyJet is still a little bit too cautious. That's my personal view. And as always, as something I said in a very early podcast, one of the more important things is to know a company better than 90% of the market. And I kind of feel with easyJet, that's not actually too difficult to do, or not as difficult to do as perhaps you would think. My feeling is that when the company gives their full year updates later on this year, and remember, of course, that many airlines have a financial year that ends at the end of September. So those numbers that they'll be giving after the end of September, they generally provide, I think, numbers formally in November, but there'll be a sort of an update before then. That's going to be the sort of point where many institutional investors suddenly think, wow, progress looks good. I'm still relatively optimistic. I still like the story. Therefore, let's make it a stock of the year at the end of 2023, rethinking about 2024. And of course, that's a great opportunity for any investor to do the opposite. As always, you've got to be, as the famous expression goes, you've got to be greedy when others are fearful and fearful when others are greedy. And I think with easyJet, the year-to-date appreciation is pretty good, but clearly you look across the last 2-3 years, the stock's performed for many obvious COVID and related reasons very poorly. But the reason why I still like the stock is that sort of comeback share price performance, which has been very apparent over the last 7 or 8 months, I think it's probably got a little bit further to go. And it's interesting, despite all the overt sort of macro or kind of newspaper negatives that you can think about, or even the fact, maybe traveling from Gatwick Airport is pretty tricky, as many easyJets go through at this moment in time. Kind of feel as if the perception towards the company's still got another bout to improve. And that's driven really by the fact that it's well run. It's in an area where it's got a good market share. There is still some need for the product. And actually, I think there is still, if you like, enough of a story there for many investor types to be saying, this is one of my 2024 stock picks. Now, actually, as always, I'll be thinking the complete opposite of that. But nevertheless, I think it is undervalued. And I thought the update on Thursday was workable. Let's put it that way. By contrast, American Express, the numbers were fine. They had, I think, for the 9th consecutive quarter, if I remember the conference call correctly, progress, growth, which you would kind of expect, that kind of natural recovery from the COVID-19 peak issues. Naturally, you would expect that they would say that younger people, younger generations are utilizing American Express more. Similarly, countries outside the United States, particularly in the developing world, are using American Express more. Yes, you would expect that. I know some of the other parts of their American, particularly business areas, were a little bit duller, but still making a little bit of progress. But my big issue with American Express is a bit unlike easyJet, I kind of feel as if quite a lot is already priced in. That's what I've always had a concern with American Express. When I look at the company fundamentally, and I know you could argue American Express is a financial company, that's a good debate. I've stuck them into the aforementioned retail travel sector. That's my personal choice. But when I run the numbers and think about sort of the underlying comments on the business, trying to work out what fair value is, I keep on coming down with something somewhat lower than today's share price. I wasn't surprised to see the shares fall on Friday after the numbers. They technically beat hopes, but I kind of feel there's quite a lot factored in there already. So I guess I'm still watching and waiting for American Express. My actual number to be, what am I getting interested at level is actually around about 135 American dollars. So still a watch, intellectually very interesting company, but not one to be buying today. In the retail travel space, if I had to choose something, easyJet's going to be right up there. Let's look elsewhere. I mentioned commodities, and it's fascinating. I talk about FCX and Newmont in a couple of minutes' time, but it is kind of fascinating where commodities is naturally a broad church, and you immediately acknowledge that I've switched my sector allocation from that kind of classic stock 600 S&P split of having sort of something in the mining sector and then a different sector covering energy or oil and gas and related, but bringing it all together, because I think when you look at the commodity sector, you've got to look at all of that space together. But I tell you, when you look at a company such as Baker Hughes, as I did in my previous podcast, or SLB, what many of us still know historically as Schlumberger, which had some interesting numbers out on Friday, it's interesting, how should you think about these companies? Are these commodity companies, or are they sitters in what I call the facilitation area? Which again, go back to podcast 19 for discussions about why I think that's an important sector to have a split for. Because these are diversified companies. Yes, they are predominantly working within the energy and related space, but it's different from being a sort of a Schlumberger or a Baker Hughes sort of company than it is being a Shell or a BP or and one of the big American oil and gas companies and related operators. So Schlumberger, or SLB as they now call themselves, good set of numbers in the sense that they continue to make progress as you would expect. And a bit like how I talked about with Baker Hughes on the previous podcast, some very clear long cycle kind of growth scope in a bunch of areas, be it in upstream, offshore, commodities, energy areas, which is all good. I like the way that SLB talked about a lot more than just the United States. They talked about the international growth scope on a multi-year perspective additionally, which is all good stuff. But a bit like how I concluded on Baker Hughes on the previous podcast, I kind of feel as if, a bit like with American Express, actually, investors have fallen a bit in love with this space. And correctly, the shares are up year to date. The shares have made very good progress over recent times. And there's a lot of rational reasons for that. However, when I kind of look forward, acknowledging that I see the reasons why the company correctly can talk about long cycle growth and perspective and decent margin scope and related. But when I think about the space, I think what already is factored in. They talked interestingly too about the fact that certain free cash flow angles they look very attractive today, will be less attractive over upcoming times, just because, as is the nature of this business, you've got to put CapEx in, you've got to put development spend in order to remain relevant, operating for your underlying customers and related. And whilst they will continue to make profits, I've seen too much of this sector over, too many cycles. I remember talking and learning about Schlumberger, my goodness, must be 25 plus years ago now. My feeling is that hope factors are firm already, and I would want a lower share price before I get involved. So I'm currently a bit like with Baker Hughes. I'm waiting for a lower share price at this moment in time. However, there are other broader and what I would now call actual commodity sector areas, which I still do find interesting. And obviously the mining space in its many guises, I can find many interesting reasons for being excited here. Next week, I'm particularly looking forward to the Rio Tinto update. We'll come back on that in a couple of podcasts' time. But kind of interested to hear what FCX said. I mean, FCX, Freeport-McMoRan, as many of you possibly may know them as, material copper and gold positions. Big ticks in the boxes. I have held the stock historically, made very good money on them. Very impressed by the way that they've particularly turned around their operations in Indonesia over recent years. And so huge ticks in the boxes there for the management team. But I must admit, and I guess it's a little bit akin to Schlumberger or SLB and Baker Hughes and the like, I kind of feel when I look at Freeport-McMoRan today, that the shares, I can see all the reasons why they're excited about copper. They're excited about expansion scope, not just in Indonesia, but further development scope across North America, actually various other parts of the Americas generally, which is all great stuff. They're remaining relevant, got a very good balance sheet. Again, scope for being a solid performer over much more than the next few years. But it's trying to work out at what point do you actually get involved, what has already been factored in and what has been underappreciated. And I kind of feel at this moment in time, at least at this share price, Freeport-McMoRan is not quite exciting enough for me to buy back into the shares. What sort of levels am I looking for? Well, something on the lines of nearer a $35 plus level would be of a bit more interest, maybe, again at a $40 level, but it's certainly lower than today's share price. I guess that's what I'm trying to say. Elsewhere, we had some insights from Newmont, big gold miner. They kind of claim that they're the biggest gold miner in the world. I guess we can debate that, particularly in terms of quality. It's a couple of weeks until the Barrick Gold numbers come out, which, as many regular listeners will know, is my perma love up in terms of the gold sector, but more on them in a couple of weeks' time or so. But I guess technically, from certain perspectives, Newmont is the most important listed gold company in the world. And as you may well know, they're currently attempting to take over the Australia-listed Newcrest gold company, which is an interesting move. I kind of feel on the deal that's been struck, obviously going through various regulatory checks and related at the moment, but I kind of feel that Newcrest kind of got the better part of that deal than Newmont, but we shall see over time. Nevertheless, well done for them for making an acquisition, and we'll see how it goes on. Kind of interesting, actually. I am, as I've talked about many times before, I do believe that gold has a place in a portfolio, and certainly in terms of the reasons for why you hold gold, I've talked about in previous podcasts. It means that companies such as Newmont or particularly names such as Barrick, they're important companies to be always following when they come up with their corporate update, trying to understand not just what they think about gold potential and potentially, beyond even just the gold price per se, the sort of the scope for investing in this sort of area, but also how the market is valuing this space. And I would still generally say that gold stocks are a bit lowly valued. I've thought that for quite a while. Quality is therefore an important consideration too, because I can understand some of the natural uncertainty there. And as we saw via the Newmont numbers, actually an update, it's a time at the moment where costs are going up, where you can have short-term challenges, be it people going on strike, other issues. And that is apparent, I think. I can see how that is still a problem for Newmont. And this is why, and one of the reasons why I've never been a particular huge fan of the stock. It's kind of interesting when I look at the company and I think about tier one gold mines in the world. I kind of just strongly feel that Barrick Gold is a much better position from that perspective. Hence why we'll see in a couple of weeks or so what they say. As for Newmont, kind of that sort of circa $40 share price level is sort of the kind of price where I would have another look, just because conceptually I like and I allocate to the gold and gold mining space within my portfolio. But is it a name at this moment in time for me to get excited about Newmont? No, it isn't. And a bit like Freeport-McMoRan, you can see some good rationale, some good medium-term scope, and certainly in the case of Newmont, actually, an attractive dividend yield at this moment in time. Is it enough though to be an investor today? No, it isn't. Below $40 actually would be a level where I'd have another look at Newmont. But Barrick Gold kind of remains my top pick in this sector. And we'll see, as I say, what their numbers say in a couple of weeks' time. It's kind of interesting to talk about dividends actually, because my next company I wanted to talk about was Johnson & Johnson. Pharmaceutical space, although kind of like quite a broad company, diversified company, of course, as we all know. It's kind of been 62 years, I believe, that they've been consistently raising their dividend payment, which is impressive to say the least. There's not many companies that can say that. It's interesting, isn't it? I've talked on previous podcasts about my view that your appropriate bond weighting within a diversified portfolio is your age minus 50, i.e. Don't hold bonds, be it consumer or government bonds, until you're 50 years old. And let's say you hit the 100 level. Yeah, at that point, 50% bonds in your portfolio. Now, I know that's controversial in the sense that many people believe from the get-go that a 50-50 or a 60-40 portfolio is the way to go. I've seen 75-25 portfolios, and let alone the madness around certain corporate bonds being 90% plus, driven by the actuaries in bonds, which I think is wholly unattractive for any certainly medium-term investor. By medium-term, I mean 5-10 year plus investor, people who are not retiring for that sort of period of time or beyond. Why on earth are they allocated in that way? But as I said, I've talked about that on previous podcasts. I'm not going to talk about it too much again right now. But it strikes me that looking through actually Johnson & Johnson and actually a couple of other companies I'll talk about later on in this podcast, kind of fascinating to see some of the solid sort of dividend yields, certainly versus things like 10-year US government bond yields that you can get, as well as obviously the growth scope that equity offers you. And I think that's such an important way to be thinking about investment opportunities. Johnson & Johnson is kind of interesting in many ways. I actually don't think the share is cheap per se. I'm not a holder of the share. I talked previously in my previous podcast about how the pharma sector is certainly, I think, underappreciated by the broader market. But I think there are other companies of more interest. Actually, a number of them are reporting over the next couple of weeks. We'll talk about those in upcoming podcasts. But it's kind of interesting to hear Johnson & Johnson talk about more business splits in their update, their latest quarterly numbers earlier this week. I think that was good to hear. I wasn't surprised to see their shares react positively to that, because that is what larger cap pharma should be thinking about. And it's certainly something I've if I mention a couple of names, I liked it earlier this week when Novartis mentioned, again, more focus on trying to split the business, even though, again, I'm not a holder there. I think there are more interesting, let's say, Swiss pharmaceutical companies to be looking at. Or if you look at like London-listed names such as GSK, I think some of their recent business splits there has been very smart, I think, from a medium-term perspective. But again, a company that's actually reporting next week, and we'll talk more about them at that point. So Johnson & Johnson, a little bit expensive, doing the right thing. Love that dividend profile. If you ever see the stock at sort of $150 odd, then absolutely, why are you not buying Johnson & Johnson shares at that level? Why are you buying bonds, etc.? A much more sensible choice. In terms of prevailing prices, much closer to being actually an attractive choice today is a company, a sector, which I know is a little bit controversial. But Philip Morris in the tobacco and related space, I know it's funny. I've never been a smoker, never will be. But I'm perfectly comfortable in buying and have done successfully over the last, my goodness, 25 odd years, operators in the tobacco and related area. And I know it's a little bit controversial, but consumers have a choice and they make that choice and continue to make that choice. And PMI is actually obviously a company which is running with today's world. It's much more than just cigarettes, which historically, of course, was the core part of the business. Clearly, the interesting and striking acquisition of Swedish Match over recent months, very positive, very helpful for my personal individual portfolio last year. But the general push they've been making with IQOS products over the last few years as well has been notable for anybody looking at PMI, Philip Morris stock opportunity. The numbers showed strong price mix, something obviously I always like, and we've talked about before on previous podcasts, the importance at prevailing levels. Price mix is so important, and unsurprisingly, still strong price mix, strong or good solid free cash flow, and hence the maintenance at Philip Morris of getting close to 5% dividend yield, which they can cover despite the fact that they do have a little bit of debt, mostly courtesy of or been heightened by the recent Swedish Match purchase. But I like the fact that they have a range of different products. It's still internationally very relevant. Let's see if they have success or not in being able to get back into the US market with IQOS in a more deeper form. But I think the Swedish Match purchase has helped nullify some of the lowish or almost zero exposures to the US space. Hence, I think a good rationale for them to buy that last year. It's kind of interesting. In my would I rather hold PMI stock than a 10-year US government bond? The answer is yes, I would. It's not that simply that you can get a better dividend yield, because you can. But it's the fact that actually I think you'll probably make some money on PMI shares from overt share price growth too. So your total return perspective is actually going to be better, I think, than, let's say, US government bonds or typical US bonds per se, corporate or government. And hence why an area such as tobacco, a company such as PMI, particularly if I could see it below $100, I would actually consider buying it. My holdings actually in the sector are elsewhere in the space. UK market's has some interesting tobacco names involved there. I've actually taken some profits on the tobacco space earlier parts of this year. It's interesting. The shares have been a little bit duller over recent months. They were very strong last year. I took the opportunity to take some profits and related, but they're kind of coming back to levels where investors looking for total return opportunity can find it if you can't find it elsewhere. So a bit like the pharmaceutical sector, a bit underestimated. And obviously tobacco and related is an overt and obvious consumer stock, right? And that's always how people should think about it. But that kind of, from a consumer-based perspective, not going to be the only company in this sector which actually your total return perspective is so much more attractive than what perhaps a multi-year government bond or even consumer bond could offer you. Yes, I know bonds are boring for a reason and related, but as I said, certainly investors who are looking from a much more than the next few year perspective, looking to the end of the 2020s into the 2030s for their personal portfolio profile. Why on earth are you even thinking materially about bonds? But anyway, another discussion. We'll no doubt come back to that in due course. Final company I want to talk about, and I said I'd talk about the tech space. I'm going to leave Tesla and related to the real experts there. Not a company I like particularly, but there you go. Many people do like them, and good luck to them on that front. But the company I wanted to talk about was TSMC, Taiwan Semiconductor, a company which is a fabulous company, high quality company. We talked on the previous podcast about ASML. So that was listed in the Netherlands. TSMC, obviously listed in actually both Taiwan, but also a bit like ASML, they've got a big and important US listing too. Great company, TSMC. But of course, kind of interesting, isn't it? Because we all know that there are reasons why even the most important semiconductor foundry business is having a few struggles at the moment from a revenue perspective, from actually a multi-number perspective. We all know the reasons why. We all know that the COVID period led to lots of computer sales or lots of usage of semiconductor underlying semiconductor usage products. And that's kind of naturally slowed down a little bit, not just because of over cyclical matters, but because of something which has been very apparent in the semi industry forever, for the 25 plus years I've been looking at it, at least, where you get cyclicality. And obviously, the thing about semis, particularly when you get into TSMC's world of foundries and relationships with their underlying customers, as well as obviously requirements for shifts and evolution of the products they're offering, sometimes you've got to have sort of more of an acknowledgement of where the industry is going rather than what it's doing today. That's always been the case in semiconductors. You've got to look forward there. And it's kind of interesting, isn't it? I mean, the thing I like about TSMC is not just the very high market share, not just the skills, the fact that from a technology perspective, I mean, looking through some of their recent progress in their operations, they still are clearly the world number one. There's still reasons why any company, either side, ASML want to supply them and companies such as Apple want to use them. And you can see the reasons why in terms of the pure quality of what they do. It's kind of interesting, isn't it? When I read about their various plants in Taiwan, and I've had the opportunity to travel to one of them. Whenever you go there, I mean, there's various obviously things you can't see, and quite correctly so, because it's a sector, an industry which is still patently, overtly relevant for the rest of the 2020s and 2030s and beyond. And am I surprised that countries such as America, parts of Europe, naturally China, but other parts of Asia too, are thinking of saying, well, we need to have a chip plant in our country. We need to start building more plants here. Absolutely. You can understand the reasons why. Another time we can talk about, the fact that, of course, all of those skills did used to be centered on Silicon Valley, parts of Germany, Japan, etc. But the skill of TSMC and one or two of their local peers as well has been to take initially the market share, but then run with it and actually ultimately have the even superior product and made a huge relevance to participate as a foundry supplier, foundry operator within the semiconductor industry. I guess what I observe is this. Number one, CapEx continues apace for all the right reasons. We know that demand for semiconductor output chips is going to be huge, only going to grow over the next decade. But for the way that we live our day-to-day lives and related. Not surprised to learn that the positive mentions for continued growth was still in the inevitable AI and related mention, but also in areas such as cars and related, where there's utilization use is still going up. And over time, yes, we will want to buy a new mobile phone, a different type of computer, have underlying usage of semi products in a variety of different general day-to-day industrial or personal usage and requirements. So there's plenty of underlying demand there. I guess where it gets interesting is, how does TSMC play this? And I'm not surprised that they're looking to grow plants in the States, in other parts of the world, potentially in Europe over time too. And that will become apparent, and those products, those plants will become apparent over the next few years. But Taiwan correctly is still having the most recent, most insightful bits of technology is still being retained there. And I can understand that. You go to Hsinchu and related parts near Taipei, and it's still very striking, obviously. Hence the sort of observation that, oh my goodness, it's going to be, that's the reason why China wants to invade Taiwan. But I think again that misses an overall point, which is clearly my personal view is that China is unlikely to invade Taiwan, just because I think the difficulty of doing so is probably underestimated. And surely Xi Jinping has learned something from the mistakes Mr. Putin has overtly made over the last 18 months or so. My other observation is that unfortunately, getting hold of intellectual capital, that's tricky, and that's something which is beyond, you got to go way beyond just holding land or holding a property and related. But anyway, we shall see on that front. All I am seeing is that TSMC remains a very relevant share for the medium term. I like the fact they're talking more about building their dividends from a lowish, but not sub 2%, but not impossible level at this moment in time. I like the fact that they're talking about the slow raising of this dividend over time. I like the fact that countries around the world have acknowledged the importance of this company. And for me, it's a question of at what point does it become cheap again? And as I say, you've got to look beyond traditional ways of trying to value companies. You've got to look a little bit towards the future. TSMC has no problem in generating free cash and profits. And so you can do a sort of a static, easy observation on what's your valuation today or tomorrow going to be. But I think you've got to get your head around a little bit, particularly when you're trying to factor in sort of your CapEx cycle and the inevitable spending that's occurring at the moment for producing returns in the next, over the next few years, how you sort of factor that in. In terms of levels, I always think about it in Taiwanese dollar terms, but you can find the equivalent in the US listing. But for me, I'm still waiting for a move back below the $500 Taiwanese dollar level as my add more price to TSMC shares. I think they're a great medium to longer term pension fund holding for all the reasons that I've talked about, rambled on at length about over the last 5-10 minutes. But adding more sub 500 Taiwanese dollars and then again at sub 400 Taiwanese dollars. I've held that view for a while now. And when you look at sort of market volatility during uncertainties, actually more post COVID-19 uncertainties with TSMC over the last 12, 18 months, the market's provided you with those opportunities. And that's the way to think about the company. It's one where really you've got to be greedy when others are fearful and related. Taiwan obviously has an election in January 2024. That will be impactful. I think that's probably true for all Taiwanese or broader Greater China companies. We shall see on that front, of course. But yeah, really high quality company. I still love TSMC, and a bit like actually ASML. You wait for those bad days for whatever reason, be it macro, be it just people getting too focused on short-term numbers, to get re-involved in that area. true of actually much of many sectors. I mean, it's interesting. Other parts of the technology space, we'll talk about many of those next week. A bunch of interesting numbers out. We'll sort of try and factor in at what point are these shares cheap again? Because let's face it, technology shares per se, just look at the performance of the Nasdaq year to date, have done rather well. And obviously that should make you cautious as an investor. And as I talked about a few podcasts ago, when I talked about Nvidia, why I'm not excited by Nvidia shares at prevailing levels. If you got involved over the last 2-3 years, then huge congratulations, you've done fantastically well. But when the company was at $1 trillion market cap and related, that just feels a bit too late for me to be chasing that share at this moment in time, at this sort of knowledge appreciation level. Similarly, the company that has been one of my biggest holdings for many, many years. Actually, I was in a meeting a few weeks ago and I underestimated how long that period was. And I looked back at my records and it did confirm to me that I'd been a pal of a friend, a holder of Alphabet shares for something on the lines of 15 years now, just under 15 years, which is fantastic. Because honestly, the share has been a huge success over that period, which is really good to know. I'm a huge personal user of many of their products. But as I said on an earlier podcast, for the first time in many, many years, I wasn't adding to my Alphabet holding on bad days. I was actually taking the opportunity to take some profit. And I sold a substantial amount of my shares earlier this year because I actually felt the share had gone too far. And I still have that view today. So looking forward to those Alphabet numbers next week. Naturally, we'll come back and talk at length about those. I still do own some shares, but it's gone from being one of my biggest positions to just being a position in my pension fund. Love many of the big thematics around it, but it's a company which I'm feeling I can't quite as easily justify certainly a big market, a big pension fund holding position and related to this moment in time. As always, the world of investment is about thinking about tomorrow, accepting that sometimes you make mistakes or sometimes you make great calls, but thinking about not just what the numbers about the last 6 or 12 months or the last quarter are saying to you, but thinking about what it really means. What's it saying to you about their scope and potential over the next little while, whether the market's already factored it in or not, and related. But you've heard me say this across the last, 23 podcasts or so, and no doubt I'll continue to say it over the next 20 or 23. But we shall see. Anyway, thanks for listening. Loads more numbers to come next week, so there'll be 2 or 3 podcasts out with various updates on companies and views and related. But thanks for listening. Keep working hard on investments and looking forward to speaking to you soon. Bye-bye.